Okay, let's just dive right into this. Welcome to Iron Financial. I'm the lead analyst. And look, our mission here is absolutely straightforward. We want to help you forge a much stronger portfolio and completely cut through the ridiculous weakness and noise we're seeing in the broader market right now. Today, we are putting Altria Group under the microscope in this full, in-depth explainer. We're drilling directly into their Q1 2026 financials, and honestly, if you want a company that tests the true, raw structural integrity of an income portfolio, Altria is the ultimate stress test. They literally just dropped their earnings, and we are going to tear apart the raw numbers, the revenue, the debt load, the margins, just to see if the steel actually holds up under pressure. Right, and I'm the market skeptic. I'm sitting here representing you, the focused learner. I look at these massive, old guard legacy companies, and I always have to stop and ask, is this real fundamental strength, or is it just Wall Street hype? I mean, are they actually building something durable for the next decade, or are we basically just staring at a crumbling foundation that's been painted over with a really fresh, shiny coat of dividends?
Because honestly, that is exactly the question we need to answer before we even look at a single spreadsheet today. Altria Q1 2026, is this an opportunity? Or is it a massive trap? We all know the prevailing narrative out there. Tobacco is a declining industry. Unit volumes have literally been falling for decades now. So do these specific earnings actually prove that Altria is a durable foundation you can confidently forge into your portfolio right now? Or is this just a classic, high-yield value trap designed to lure in unsuspecting income investors right before the entire structure completely collapses inward? We demand absolute clarity today. No corporate PR spin. We just want the bare metal blueprint.
I absolutely love that energy. Let's get right to work then. Section 1, the drill down on revenue. So we are inspecting the structural integrity of this balance sheet, and you absolutely have to start with the top-line numbers. You simply cannot build a financial fortress without capital, so we need to see exactly how much capital Altria is actually pulling out of the market. Let me tell you, when you sit down and look at the raw SEC filings, the sheer amount of cash this company generates is just staggering. We are looking at an absolute top line of $5.428 billion in net revenues for the first quarter alone. Let that sink in. That is a 3.2% increase year over year from Q1 2025. And it gets better. If you strip out the excise taxes, that heavy toll that comes right off the top and goes straight to the government, the revenues net of those taxes actually grew even faster, up 5.3% to hit $4.758 billion. Now, why does this matter so much? Because context is literally everything in this market. We are operating in an environment defined by severe macroeconomic pressures. We've got persistent inflation, incredibly high consumer debt, and it's all just crushing discretionary spending across the board. So growing your top line by over 5% in that environment, that means you have absolute forged-in-iron pricing power. They are charging significantly more for their products, and guess what? Their core consumers are still paying it. That resilience is the very definition of a solid foundation when the rest of the market is turbulent.
And listen, this pricing power translates directly and forcefully to the bottom line. $1.32. That is Altria's adjusted diluted earnings per share for the entire quarter.
Okay, hold on a second. Adjusted diluted EPS? Why are we suddenly giving them a pass and looking at the adjusted number instead of the reported $1.30? That feels a bit like moving the goalposts.
It's definitely not a pass. It's about analytical precision. Adjusted diluted EPS strips out the one-time accounting noise that clouds the real picture. Specifically, here we are looking past things like last year's massive non-cash impairment charge on their e-vapor reporting unit. Think about it like this. When a company writes down the value of an asset on paper, it hits their reported earnings incredibly hard, but it doesn't actually affect the real, physical cash flowing through the business that specific quarter. Taking the adjusted number gives us a much cleaner, more accurate view of their ongoing, day-to-day operational earnings capacity. It's kind of like looking at a heavy-duty truck's regular highway fuel efficiency rather than judging its performance by a single freak trip where it was coasting downhill with a massive tailwind. And on that clean, adjusted basis, their EPS grew a massive 7.3% versus Q1 2025. That is serious, undeniable operational leverage built right into their core model.
Okay, fine. The headline steel looks shiny. I will absolutely give you that. Sustaining 7.3% EPS growth in this brutal macroeconomic environment is nothing to scoff at. But I really need to know where this cash is actually being forged. Are there new, highly touted transition products actually carrying the weight here? Or are we literally still relying entirely on the legacy business to keep the lights on?
That's the million-dollar question, isn't it? Well, the numbers give us the answer.
Out of that $5.4 billion in total net revenues, a staggering $4.758 billion comes directly from smokable products. Oral tobacco is sitting at just $669 million. So, despite all the industry talk, all the flashy investor presentations about transitioning to a quote-unquote smoke-free future, over 87% of their revenue is still forged squarely and completely in the combustible segment. Marlboro is undeniably the main load-bearing pillar holding up this entire corporation.
But the real metric that absolutely demands your attention is the profitability of that smokable pillar. The raw data from their 8K filing shows the smokable segment didn't just tread water, it delivered a 5.2% growth in revenues net of excise taxes, hitting $4.11 billion. And here is the number that should make any fundamental analyst immediately sit up and take notice. Their adjusted operating company's income, or OCI margins, expanded to 65.1%. Let me be clear, that is an incredibly rare, almost unheard of level of profitability for any physical product business. How on earth do they achieve that? By requiring incredibly low capital expenditures to maintain their legacy manufacturing lines. The factories are already built, the supply chains are fully optimized, and the marketing spend is highly restricted by law anyway. So for every single dollar of revenue net of excise taxes they bring in, 65 cents drops straight down as operating income. That margin is the impenetrable armor protecting their massive cash flow.
Which brings us perfectly to Section 2, heavy lifting, shareholder returns.
Because look, when you have a machine that consistently generates a 65% operating margin, you produce an absolute ocean of free cash. The ultimate test of any management team is what they actually do with that cash. Do they squander it on overpriced, ego-driven acquisitions, or do they fortify shareholder value? Here is the exact blueprint of their capital return program for the first quarter of 2026. First up, share repurchases. They deployed $280 million to buy back 4.5 million shares at an average price of $62.33. By retiring those shares, they are permanently increasing the ownership stake and the future claim on earnings of every single remaining shareholder. But the real heavyweight here, the absolute anchor, is the dividend. They distributed a staggering $1.8 billion in pure cash dividends in a single 90-day period. You have to understand the psychology of the dividend investor. A reliable $1.8 billion payout acts as a massive gravity well for income portfolios all over the world. That is unparalleled cash-generating ability, being handed directly back to the actual owners of the company, quarter after quarter, like clockwork.
All right, let's tap the brakes for a second and look at the structural mechanics of this. Yes, $1.8 billion in dividends is a massive, undeniable payout. No argument there. And I see they still have $720 million remaining on their $2 billion share repurchase program, which expires at the end of 2026. But here is my fundamental structural problem with this entire setup. Buying back shares reduces the total share count. When you shrink the denominator, you mathematically boost the earnings per share, even if the actual, real net income of the company stays completely flat. Are we just looking at sophisticated financial engineering here? Is management aggressively buying back stock just to mask underlying structural issues in the core business? Because let's be real, if the foundation itself is sinking into the mud, buying up fewer shares of a sinking building doesn't save the structure. It just concentrates the risk for the people still inside.
And that's exactly why we need to move to the next phase of our analysis. Section 3, cracks in the armor. We've seen the glossy headline numbers. We've praised the pricing power and the insane margin expansion. But you simply cannot analyze a manufacturing company without looking at the raw volume. How many actual physical units are they moving out of the factory doors? Let's push past the revenue hype and expose the structural weaknesses hidden deep in the volume metrics. This right here is the critical divergence that every single Altria investor must confront head-on. On one side of the ledger, you have smokable revenue growth up 5.2%. Great. But look incredibly closely at the other side. Domestic cigarette shipment volume declined by 2.4%. And honestly, if you dig deeper into the footnotes and adjust for trade inventory movements, total domestic cigarette industry volume actually decreased by an estimated 5%. So the crucial point is this. Altria is making more money, yes, but they are doing it by selling fewer and fewer physical cigarettes to a rapidly shrinking base of consumers. They are actively offsetting a steadily sinking foundation with aggressive, relentless price hikes. We have to talk about price elasticity here. There's a strict mathematical ceiling to how much you can raise prices before that 5% volume decline accelerates into an absolute death spiral. How long can that structural math possibly hold up before the consumer just breaks and walks away?
I concede the point entirely. You hit the nail on the head. The volume pressure is absolutely real, and it's not just isolated to combustible cigarettes either. If we look at the oral tobacco segment, which is supposed to be a major part of their future blueprint, we see similar structural stress.
Total shipment volume for oral tobacco actually dropped 3.1% this quarter. Their overall retail share in the oral category took a pretty massive hit, falling from 34.5% down to 29.0%. Modern oral formats are intensely, brutally competitive right now. You've got rivals aggressively discounting and promoting products like Zyne to capture market share at all costs. However, you have to look at the structural reinforcements Altria is actively building to fight back. Their On nicotine pouch brand, which is their direct, head-to-head answer to Zyne, saw its volume surge by a massive 17.6%. So while the legacy oral products like Skoal and Copenhagen are bleeding share in a hyper-competitive space, their modern, smoke-free pouch is rapidly gaining serious ground. It's a real battle.
Let's look ahead. Section 4, the Forward Guidance Blueprint. We know exactly where we stand in Q1. The margins are ironclad, the cash is flowing heavily, but the volume foundation is definitely contracting. That means we need to examine the architectural plans for the rest of 2026 to see if management honestly believes this structure can hold up for the full fiscal year. Despite the volume cracks you rightly pointed out, management is not backing down an inch. They are officially reaffirming their 2026 adjusted diluted EPS guidance, projecting a range of $5.56 to $5.72. If they hit that blueprint, it signals a very solid 2.5% to 5.5% growth rate from their 2025 base of $5.42. And what's really crucial here is that they expect this growth to be much more balanced between the first and second halves of the year, supported by progressive increases in cigarette import and export activity. They are stating definitively on the record that they are confident the math works.
Confident, sure, maybe. But as an analyst, I demand total clarity on exactly what structural headwinds are baked into these projections. Look closely at the variables they explicitly list in their own forward-looking statements. They are factoring in macroeconomic uncertainty for adult nicotine consumers. That is polite corporate speak, meaning their customers are feeling the severe, crushing pinch of inflation, which makes relying on those aggressive price hikes even more incredibly dangerous moving forward. They also note moderated e-vapor industry growth. But the absolute real gut punch in this filing is point number 4. They are officially modeling that NJOY ACE does not return to the marketplace in 2026 at all. Remember, they got hit with an ITC exclusion order basically banning the import and sale of NJOY ACE in the US due to ongoing patent disputes. This isn't just some minor regulatory hiccup. NJOY was supposed to be a major, load-bearing pillar of their transition away from combustible tobacco. Now the regulatory hurdles have completely sidelined it for the entire year. That puts an immense, almost entirely unfair amount of weight right back onto the shrinking Marlboro Foundation to carry the dividend.
Which brings us to the final stage of our analysis today. Section 5, the verdict, opportunity or trap. It is time to weigh the massive, undeniable cash flow against the equally undeniable volume deterioration. I'll take the first swing here. I look at this quote from CEO Billy Gifford: "Our highly cash-generative businesses supported significant returns to shareholders through dividends and share repurchases." And look, that is the absolute, unvarnished truth of this company. Yes, the unit volume is cracking. Yes, the transition to a smoke-free future is hitting brutal regulatory brick walls like the NJOY ITC order, but their pricing power is so uniquely dominant and their margins are so incredibly thick at over 65% that they can absorb these massive structural blows and still confidently hand you $1.8 billion a quarter in cold, hard cash. For a pure income investor looking for a durable, heavy-duty dividend that has weathered absolutely every storm for decades, Altria's unparalleled cash-generating ability makes it a rock-solid play. The math works, and the yield is incredibly real.
The yield is real today, I will grant you that without hesitation. But a truly strong portfolio is built to last decades, not just the next few quarters. You have a company growing its EPS by 7.3%, but doing it almost entirely on the back of aggressive, relentless price hikes on a product that 5% fewer people are buying every single year. That is a dangerous, high-stakes game of financial Jenga, and eventually, you simply run out of pieces to pull from the bottom. So, I leave it up to you, the focused learner. Look at the blueprint we've laid out today. Will you forge Altria into your portfolio and collect that massive cash yield while the machine is still running hot? Or is the smoke finally clearing, revealing a company that is slowly, steadily liquidating itself just to delay an inevitable structural decline? That is the decision you have to make. Thanks for drilling down with us on this explainer at Iron Financial. Keep your analysis sharp and your portfolio stronger. See you next time.
Quick disclaimer, everything I share is for entertainment and informational purposes only. I'm not a financial advisor, so please do your own research or talk to a professional before making any moves with your money.